I can tell it's going to be one of those nights. Um, anyway, I just want to mention that, at least I can still continue recording this. What'll probably end up happening is if you want to watch the recordings, it'll probably end up being broken up into little pieces, especially if this keeps happening. So, but at least you can watch it. So I've had this experience before. Zoom sometimes doesn't work properly. It just keeps, breaking down like this. So we'll carry on as much as we can. But when you go to look for the videos, probably there'll be one separate recording for each time it breaks down. Okay, so like tonight, there's going to be like basically two recordings, assuming this doesn't happen again. Now, I was able to go ahead and close out a lot of the websites I had open, and I'm hoping that that will free up the system resources so this doesn't keep happening all night. So anyway, let's get back to where we left off with the Wall Street Journal. What I wanted you to see here is that they actually quote every exchange rate in two different ways. For example, um, let's look at the dollar and the pound, and you'll see it's way down here. Here it is, UK pound. Now, if you notice here, this quote is $1.2445 per pound, but that implies that it only takes 0.8035 pounds to buy a single US dollar. Okay, you can see they both mean the same thing. So if it takes $1.2445 to buy a pound, the inverse of that is 0.8035, which is the same thing as saying it takes 0.8035 pounds to buy a single dollar. So all of the exchange rates are quoted both ways. With the Bloomberg, it was just a brief highlight of a lot of the most commonly used trading pairs, but here they're covering it all. You can see everything's here. I think they've got every single currency in the world listed here, even many that you've never heard of. And we'll discuss this later on in the course, but I want to draw your attention to Ecuador. Look at Ecuador. You notice how it's listed as just one. Why is that? What is going on with that? It's not even 1.000 something, it's just one. That's because about 25 years ago, Ecuador decided that they didn't need their own currency. They were having a lot of inflation. Their economy is in really rough shape. They decided to scrap their own currency and adopt the US dollar as their own currency. So, in other words, Ecuador doesn't actually have their own currency, they use the dollar. So that's a process called dollarization, and we will discuss this later on in the course, but I just wanted to draw your attention to that. I don't see any others here right now, but there have been times when other countries did the same thing, but it basically means your own currency is in such rough condition that you just abandon it and you replace it with the US dollar, which is, of course, a much more stable currency. So this happens from time to time. And again, it's called dollarization. It has a lot of good advantages, but it also has some major drawbacks. So there's some other interesting ones here, like the peso, Mexican peso. At the moment, it takes more than 20 pesos to buy a US dollar, which, it's pretty weak. It's been weak for a while. Some of these, like in Argentina, you have to spend over 1,000 pesos to buy a dollar. Some of these are quite high. But then you get the other extreme too. If you go to the Middle East, each Saudi Arabian rial is worth over $3.75. Okay. The South African rand is worth over $18. So you never know. Look at that. The Egyptian pound, 50. So anyway, if you really need to research these exchange rates, this is a good place to get them on the Wall Street Journal. Oh, here's another one that's interesting. The Chinese yen, it's called 7.25. This one is semi-fixed. It's not fixed in the same way that the Hong Kong dollar is. The Chinese currency is pegged to a basket of currencies of its major trading partners, of which the dollar is in there too. So that means this number doesn't fluctuate too much, but it's not completely fixed either. Okay. All right. So let's get back to this. Okay, what's happening now? Yeah. I guess we're just in for a tough night. I mean, I just used this like 2 days ago for another tutoring session, and I never had any issues whatsoever. So naturally enough, it has to crap out tonight. So I'll just keep going and do our best. And so what I wanted to do is go back to these slides and carry on from where we left off. And so, by the way, most currencies do have a special symbol associated with them. These are the ones you're most likely to have seen. This is the British pound. This is the Japanese yen. The euro has this symbol that looks like a fancy E. Now, what's interesting about the euro symbol is that when the euro was introduced, the public was actually consulted on which symbol they would like to see used for the euro. This is very unusual. Most of these just evolved over time, but the euro was actually chosen by the public, or at least they were allowed to have input into which symbol they would like to see on the euro. Now, and again, this is something we'll see later on in the course. The euro is actually the common currency of 20 countries in Europe. They all use the euro. They don't have their own currency. And it's been around for about 25 years now. And it's an extremely interesting history, which we'll get to in a later chapter. Okay. We want to talk about this in great detail because it's an extremely interesting historical event. You in the past, there have been currency unions, but not with so many countries involved. Okay. 20 is completely unheard of by historical standards. In the past, you might see two or three small countries get together and share a common currency, but not 20. This is something that was unheard of, and a lot of people predicted that it couldn't last. But so far, it's hanging in there. Although I must say, there have been a few times when it looked like it might not make it. There were a couple of crises about maybe 10 years ago where it looked like Greece might have to leave. And people were thinking that if Greece leaves, some of the others might leave and the whole thing could potentially fall apart. Now, of course, you know that Great Britain never joined the Eurozone. They always kept the pound, but they did leave the European Union, which is a free trade agreement between these countries. If Britain had adopted the euro, it would have been much more difficult for them to leave. But because they never did, it was easier for them to simply withdraw. All right, now, as we started to talk about before, you saw in that Wall Street Journal page that there's two different ways of quoting a currency. For example, the dollar and the pound. Now, this is taken from a week or so ago, but if you notice, we have 122.96 per pound, which is equivalent to 8133 pounds per dollar. How do we go from one to the other? We simply divide it by one. Okay? In other words, if you take out your calculator and type 1 divided by, let's do this, 1 divided by 1.2296, it's going to be 0.81327, almost exactly 0.8133. So think of these as inverses of each other. Okay. It's the same information expressed in a different way. Okay. Now, some currencies by convention tend to be priced as so many units of the foreign currency per dollar, and others tend to be quoted as so many dollars per unit of the foreign currency. And that you can tell by looking at that Bloomberg page. Let's go back there for a second. Oh, by the way, this page finally woke up. Oh no, these are the foreign. Oh, what happened here? There you go. So as of the end of today, the Dow Jones went up about 136 points, the S&P about 55, the Nasdaq went up about 400 points. Now, why did it go up so much? Because yesterday it crashed in a big way because of that news about the Chinese AI company. And what often happens in the markets is that when something negative happens, a lot of people will start selling a stock or a series of stocks because they're getting very nervous. And so what often happens is they overreact. A lot of people sell the same stock. The price falls off quite quickly. And then everyone says to themselves, listen, maybe the price fell too far, too quickly. Why don't we buy it back? And so suddenly, before you know it, it's almost right back to where it started from. So that's exactly what seems to have happened here. We've got NASDAQ bouncing back, which means that traders realized that the stock was oversold and they bought it back because suddenly it's cheaper and easier to buy it. So when you see all this green, that's a good sign because it means that markets are doing well. Now, the VIX, which we'll see later on, is a volatility index. And here, this is one thing you want to see going down because more volatility means more turmoil in the markets. So when the VIX index goes down, that means the markets are calming down. And that's a good sign. Most assets will benefit from less turmoil. So that's one of the many reasons why the stocks went up today, because there was less worry about the Chinese AI company. And anyway, so we'll find as we go along that many factors affect the values of currencies, not just turmoil in the markets, but interest rates will have a huge impact, expectations, investor confidence, any kinds of financial or economic news coming out of a country, inflation, GDP growth, you name it, anything, virtually anything can affect currencies. All right, they're very volatile. They change very rapidly over time, typically. In fact, if you were to go to a website like FRED, the Federal Reserve Economic Database of the St. Louis Fed, and look at the recent history of the U.S. dollar British pound exchange rate, you'll see that, well, you'll see when we get there, it's pretty volatile. It looks like somebody's EKG. I mean, really, bounces up and down and up and down in response to changes in economic variables. It's not stable at all. If you're investing in currencies, you're in for a wild ride. Let's put it that way. So anyway, cross exchange rates simply means you've got a quote which does not directly involve the dollar. Like here, for example, 191.51 yen are required to buy a single British pound. Now, where did that come from? Well, this is where the dollar gets involved. If you notice, I've taken the yen dollar quote, the dollar pound quote, I've combined them by multiplying them together, and the result is this number here. Okay, so these are known as cross exchange rates. If you look again at the Wall Street Journal page, it does have a list of them somewhere. Here we go. Key cross rates. So how do you read this table? Well, let's look at this Japan. This tells me that it takes 162.26 yen to buy a euro. It takes 25.5725 pesos to buy a pound, et cetera, et cetera. Okay. This is the Canadian dollar, by the way. So, you can look these up, you can calculate them yourself. But as long as there's no dollar mentioned in there, you'll see that's known as a cross exchange rate. And if you're interested in this kind of thing, if you notice the Bitcoin, it's listed here as an exchange rate. So many Bitcoins, or actually in this case, it's so many dollars per Bitcoin. And you notice it's over $100,000. Oh my God. Now, there's also these special indices. The Wall Street Journal has its own dollar index. US dollar index is here. What this is an attempt to capture the behavior of a large basket of currencies all at once rather than looking at individual exchange rates. So why? For example, you might want to know how the dollar is doing against all of its major trading partners, not just individual exchange rates. So let's see if we can find a definition here. All right, then, here it is. It's the measure of the dollar relative to a basket of foreign currencies. It was created by the Fed, and it is the dollar. It's basically the average exchange rate between the dollar and the euro, the Swiss franc, the yen, the Canadian dollar, the British pound, and the Swedish krona. So we probably could find. Oh, and by the way, this is the interesting part. They don't just average them out. They don't just add them up and divide by six. They have to take into account how much trade we do with each of these countries. So it's a weighted average, and you can see the weights are listed here. So the dollar euro exchange rate is more than half of the total. Then the others are the yen, 13.6, the pound, the Canadian dollar, the Swedish krona, and the Swiss franc. Those are trade-based weights. So that way, when this index moves up and down, you can see how the dollar is doing against the currencies of its major trading partners. Okay, sometimes that can be very useful information. Okay. Now, the Wall Street Journal has its own version of this. It may be proprietary. They may not be willing to tell us what's in it. I'm not so sure about that. Let's see if we can find it. Um, no, maybe. No, they're showing us the numbers, but I don't think they're going to let us know how they constructed it. By the way, if you're interested in knowing how stock markets are doing throughout the world, they have that here too, of course. Um, it's they've got everything. Okay. All right. Anyway, let's look back here. I also there's some others here, like this is how many yen it takes to buy a pound, a euro rather. How many euro? We saw this earlier. How many pounds to buy a euro? And SF, that's technically not the correct abbreviation for the Swiss franc. Technically, it's CHF, but I wrote SF, so it's obvious which one it is. How many Swiss francs per euro? Now, this is an interesting idea. The concept of the vehicle currency. Much trade throughout the world is denominated in dollars. All those exchange rates, if you notice, were quoted against the dollar, even the cross exchange rates. The dollar is considered to be the so-called vehicle currency. You can think of it as the benchmark against which all the other currencies are measured. And that's, of course, because the US economy is by a long shot the largest in the world. Okay, so that's the logical choice. But it wasn't always that way. Just before World War I, during the days of the British Empire, the British pound was the vehicle currency. Most trade was denominated in pounds, and exchange rates were quoted against the pound. But now the dollar has taken over. It is now the world's vehicle currency. Now, if you go back to the last 30, 40 years, you'll see a lot of newspaper and magazine articles where they claim that the dollar will be replaced as the vehicle currency by other currencies. Some years it was the yen that was supposed to become the new vehicle currency. Then at one point it was supposed to be the euro and then the Chinese yen. But you know what? The dollar is still standing. It's still the vehicle currency for the rest of the world. And it'll probably stay like that for the foreseeable future. Okay. So anyway, now here's an interesting feature of the foreign exchange markets. And you may have experienced this if you've ever traveled to a foreign country. Let's say you are about to get on a plane for London, and you need pounds. You realize, I don't have any pounds in my pocket. Maybe I better get some. And you run up to the desk where they're selling currencies, and you notice there's two numbers there. And let's say it looks like this. Usually in practice, these exchange rate quotes have 4 digits. So why are there 2 numbers? What are they trying to tell you? Well, these are dealers, and that means they're willing to either buy or sell pounds with you. And so, but they have to make some money. So what they're basically saying to you is this, you can buy all the pounds you want at this price, and you can sell at this price. So in other words, imagine every time somebody comes up to the window, they're selling pounds at a relatively high price and they're buying them back at a relatively low price. That's where their profits come from. So the one on the left is known as the bid price. Right, is the ask price. The spread, the gap between the two is called the bid-ask spread. And this is the difference between the two. In this case, that would be 1.2483 minus 1.2275. Approximately 2.02 dollars per pound. That is their profit margin from dealing with their clients or customers. Okay. So 2 cents per pound roughly is how much they're making on each transaction. Now you might say, well, that doesn't sound like a lot of money, but let's face it, if you're only buying 100 pounds at a time, that's only $2. So the interesting part here is this. The size of this spread, since foreign exchange dealers make their money from the bid-ask spread, the size of the spread depends on the size of the transaction. Okay, now this is what you might have experienced if you've ever traveled. For small transactions, the bid-ask spread will be very wide or very large. For large transactions, it'll be the other way around. All right, now you can see why. Let's do a couple of examples here. Okay, so for example, for a customer who's only buying 100 pounds, bid-ask spread might be, or the bid and ask prices might be, all right, let's say it's $1.18 per pound. So in other words, it's going to be quite a bit different. So in other words, you're looking at quite a significant gap here. In this case, the bid-ask spread is about 21 cents per pound. But that's only 100 pounds. So you're looking at, $2. No, that's $20. That's a lot of money. No, so anyway, but imagine if instead, actually, no, it's probably even worse than that for small transactions. But let's say instead that instead of a single individual who is going abroad, it's a large corporation. So, corporations need currencies all the time because they may do business overseas. So a large corporation who is buying, let's say, 100,000 pounds. Well, now you're talking about something completely different. So instead of 20 cents or something ridiculous like that, you might end up being like really, oh, it could be fractions of a percent. Um, like something like this, 0.00, what is that? Three zeros and a two. Now, why can they afford to do this? Because it's 100,000 pounds. And so they can afford to have a very tight bid-ask spread because they're going to make a nice piece of change because of the size of the transaction. So they can give you a quote that reflects that. Okay. If they don't, you'll just go to somebody else. Okay. It's a very competitive market. So they have to be competitive with everyone else. And they can't just say, well, we're going to charge more. No, it doesn't work that way. Now, what's interesting about this is that if you look at the Wall Street Journal, the prices we were looking at earlier, um, you didn't see bid and S spreads. Or let's look at Bloomberg again. There's no bid and S spreads. There's a single number. And how is that? Because what they're telling, like this one, for example, 104.32, that means this is the midpoint between the bid and the S prices. So in other words, if you're actually going to buy or sell euros or dollars, this is not the number you'll pay. This is the halfway point between the bid and the ask prices. So all these quotes of a single number are really not single numbers. Those are not numbers you can trade at. So the quotes that you see, shown in the Wall Street Journal, Bloomberg's, etc., are the midpoint of the bid-ask spread or bid-ask prices. Okay. So just be aware of that. All right. Now, here we're getting back to this. The bid price is which the price at which you can sell the currency to a dealer or they'll buy it from you. The ask price is the price at which you can sell it back to them. And just keep in mind, it's easy to remember which is which because you're always at a disadvantage here. You're always going to pay the higher price. You're always going to receive the lower price because the dealers have to make money. All right. They're doing you a service by offering to buy or sell a currency. If they won't sell it to you, where would you go? Okay. So they're providing you with a service, and this is how they make their money from it. All right. So keep that in mind. And so here's another example. So this means if you see these two numbers, that means I can buy them at this price and I can sell them at this price. Now, this is these numbers are very close to each other, which means this is likely to require a very large transaction. Otherwise, you're not going to see numbers like this. Okay, let's see. Now, the chapter briefly introduces what are called foreign exchange derivatives. This is a very complex chapter, by the way, and we're going to have entire chapters based on this later on. But for now, we just want to know what, in general terms, these foreign exchange derivatives actually are. So the basic types. Oh, and by the way, what exactly is a derivative security? Just let me just quickly define that for you. A derivative security in general, it doesn't matter if it's a foreign currency one or not, is a security whose value is derived from other securities. Okay. These are used for hedging risk and or speculation. And the bottom line here is that if they're not used correctly, they're horribly risky because you can lose enormous quantities of money in a hurry if you don't know what you're doing. Okay. And in fact, there have been many scandals in the financial markets in the last 20, 30, 40 years that involve the misuse of derivatives. But the purpose of them is to be able to get rid of risk. That's why they exist in the first place. Whether people use them that way or not is a different question. But their goal, the reason why they exist, is to make it possible for you to reduce or eliminate your foreign exchange risk. Now, we're going to see later on in more detail what these securities are all about and how to use them. But for now, they just wanted you to be introduced to the idea. Now, just to give you a sense of how useful and powerful these things are, if you look at the end of the last year, just currency options, which are a special type of derivative, the open interest in these things at the end of last year was over $500 billion. That's a lot of money. Okay, it's not $7 trillion, like the currency markets, but it's still a lot of money for these securities whose only purpose is to let us hedge risk. So some of these do trade over exchanges, some of these trade directly between dealers. Okay, so let me just quickly show you an exchange where you could buy these derivative securities. It's called the Chicago Mercantile Exchange. And when you get there, you'll see that they have all kinds of derivatives available for investors. And so if you look at the markets, look at all these types of derivatives you can buy. You can get them based on agriculture, cryptocurrencies, energies, stocks, foreign exchange, interest rates, metals, et cetera, et cetera. So FX, by the way, stands for foreign exchange or currencies. So you could go in here and say, well, listen, what do we have? And you'll see, actually, let's look at data. No, I think they're just tooting their own horns here. Kind of frustrated here. They can't. Oh, here we go. Let's look at these. These are futures contracts, which we'll discuss later on the euro, the Japanese yen, the British pound, and the Australian dollar. They also have emerging markets contracts for the Mexican peso, the Brazilian real, the Russian ruble, the South African rand. And so if I am doing business in these countries, I can use these contracts to help reduce the risk of losing money through foreign exchange exposure. That's why they're there. I could still use them to gamble or speculate, but the main reason why these are here is so that we can hedge away our foreign exchange risk, which we'll discuss in that chapter. Now, other types of derivatives exist that are traded directly between counterparties, and that market has a special name that's referred to as the over-the-counter market. Okay, I'm not sure where that name comes from, but this is the over-the-counter market. And oh yeah, here's a link. By the way, I do want to point out one other thing if you are interested. Under all these different links, they have something here called research. Yes, education. So they have all these free courses you can take to learn more about derivatives, and they're all completely free. So if you want to know what a futures contract is, or any of these others, it's right here and it's completely free. How do you like that? Okay. So the four basic types are called forward contracts, futures contracts, swaps, and options. A forward contract, as the name suggests, is a contract to buy or sell an asset at some point in the future. But the key to the whole thing is that it's at a price agreed on today. So in other words, we're locking in the price at which we can buy or sell a currency in the future. I'll show a quick example of this. Okay, so let's say, for example, you look in the Wall Street Journal and you see that the spot exchange rate between the dollar and the pound is 129.80 per pound. And then you see this other interesting quote here. The 6-month forward exchange rate is 127.15. Now, what that means is I have the right to enter into a forward contract to either buy or sell pounds in 6 months at a price of 127.15. It's locked in. So that means if I get into this contract, I know in advance how much I'll either pay for or receive for British pounds. And you can see that's a perfect way to get rid of all of my foreign exchange risk if I'm doing business in Great Britain. So I can lock in the price. I'm trying to think of a comparable example. Imagine, let's say you decide to buy a new car. And but it's not going to be ready for a while. It's something specialized you have to order from, let's say, Europe. If you can enter into a contract to lock in the price, you've just entered into a forward contract because you're going to take delivery of the car in 2 months at a price that you've agreed on today. There will be no surprises when the car arrives. So, and they'll have delivery dates at any point in the future that you might be interested in. These contracts can be specified to anything you need. If I need to take delivery in 9 months, it's not a problem. What's really nice about these contracts, though, is that I don't have to just buy the heavily traded currencies like the British pound. I can actually enter in a contract. And again, if you go back to the Wall Street Journal, you'll see they had them all. Um, see, where did it go? Let's say I need to buy Uruguayan pesos. Well, that's not going to be a problem because I can enter into a contract with a bank probably in Uruguay and then say, listen, I want to buy pesos in 6 months. And they'll say, sure, here's your price. And they'll lock it in and you're all set. Okay. Now, futures contracts are similar to forward contracts, except there's a few major differences. One of them being that these are or traded on exchanges like the Chicago Mercantile Exchange. All right. Forward contracts are settled directly between counterparties in the over-the-counter market. The advantage of that, by the way, is that these can be customized to anything you need. The futures contracts, there aren't really a lot of different ones available. You basically have to take whatever they have. Let's go back and see if I can find that one again. Mhm. Oh boy, I can find. Hold on. So anyway, if you're interested in British pounds, these are the contracts you can get into. And you see they're all the same except for the delivery dates. I can take delivery in February of this year, March, April, May, June, September. But the one thing they all have in common is the amount of pounds that you're allowed to buy with this contract is 62,500. Now that it can't be changed. It's going to be the same no matter which contract you buy. So if that's not the amount that you need, well, then maybe this is not the market for you because you don't have any real control over that. The terms and conditions are set by the exchange, and they only have a few choices here. So the advantage to that from their perspective is that with so few contracts to choose from, the volume of trading in each one is very, very high. And that makes it easier for the investor who may want to change their mind and get out of this contract. So having a large volume of standardized products can be advantageous, but it also means you have no control over it. You can't choose something different if they don't have it. Okay. So there are good things about this and bad things about it. So each individual company or individual has to make up their own mind which of these products makes the most sense for their particular needs. All right. So it's good to know that they're both available, but depending on the circumstances you're in, one of them is likely to prove to be a better choice than the other. So yes, now also one of the bad things about forward contracts is that you better do business with a company that's safe. So if I go to a commercial bank and say, listen, I want to buy a contract to buy British pounds in the future, what happens if that bank goes out of business? Well, then you're out of luck. So forward contracts expose us to credit risk. Futures contracts do not, because the exchange guarantees the performance of all of these contracts. What else is different between them? We can get out of a futures contract very easily by taking the opposite position. Like if I'm buying British pounds through a March 2025 contract, and I decide that I don't really want the pounds after all, I can enter into another contract to sell them in March, and then the two contracts offset each other. With a forward contract, you're pretty much stuck with whatever you agreed to. It's a legally binding contract. So these give us the flexibility that it's easy to get out of these positions. All right, let's see. Now, with the futures contracts on the exchange, you often will find yourself needing to put money in a special account called a margin account, which acts as collateral, and the value of that account fluctuates every day. With a forward contract, we don't need to do that. Okay, so again, there's some good things and bad things about both of them. You have to decide as the hedger which one makes the most sense for your particular situation. Now, swaps. Oh, yeah, go ahead.
When we say that, like, if I go to a bank and he tells me, I tell him that I want in 6 months dollar, and he gives me a forward rate. Like,
Yes.
based on what does he give me the forward rate? And
Mm.
if he does know the forward rate, doesn't this mean that if he expects the price to increase or decrease, that he should invest in the foreign exchange market now, based on
Well,
that?
that's a very good question. Now, we're going to get more deeply into this later on, but there's a specific formula that you can use to calculate the forward exchange rate. It's based on the current or spot exchange rate and the interest rates in the two countries that are involved in that currency. So in other words, if I'm buying British pounds through a contract like this, the forward price or forward exchange rate depends on the current price of the dollar, the US rate of interest, and the UK rate of interest. And so they all tie together to come up with a formula that gives us the correct forward exchange rate. And we'll see that this formula doesn't depend on anyone's opinion, because if the wrong quote is given, then you could earn risk-free profits by either borrowing one currency and selling the other, or vice versa. So it's a very complex process, but we'll see this when we get to that chapter later on. But it's not just somebody's opinion and what the dollar is going to be in the future. It's a very precise mathematical relationship. Okay, so hold that thought until we get to the chapter on futures and forwards. Then we can explain in very great detail how this works. Okay. All right. And then options, this is the most interesting of all the derivatives. Options are a security where you have the right to buy something or sell something, but you're never required to do so. Okay. So in other words, you can change your mind. But the unfortunate thing about options is that you have to pay for them, and they're fairly expensive. The others do not have an actual price. Okay. In the case of the futures contracts, you may have to put up some collateral, but you're not actually buying the contract. Here with this option, you are in fact buying the option. And but having said that, this is the most powerful and flexible hedging security available in the marketplace because of the ability to change your mind and walk away from the whole thing. Now, by the way, just if you want to see, the only example I can find on the internet of options is if you go to this website called finance.yahoo.com. And here, if you, let's say you choose Apple stock. This website only has stocks, by the way, and options on stocks. If you look at all the information they have in this website, way over here somewhere, it says options. And so these are options available on Apple stock. And we'll discuss this in more detail later on, but if you, let me just pick one at random. This one, let's say, this is the one, this gives me the right to buy Apple stock for $230 a share. Now, Apple is currently selling for $238.26, so this is a very valuable option. But the price I have to pay is $10.50. So that's a lot of money for an option. But if the price goes up, I'll make more money. If the price goes down, I'll lose the amount that I paid for the option. But I'll never, even though I have the right to buy the stock, I'm not required to do so. And that's why it's called an option, because buying the stock is optional. Okay, so these are the most powerful hedging instruments, but again, we have to buy these and pay for them. All right, so that's our basic look at the derivatives markets in the foreign exchange, or at least the foreign exchange derivatives. They all behave the same way, depending on, but there's many other types of derivatives available, as we saw in the CME website. Oh God, where is it? I think I clicked it off. But remember that we saw that list. The products, here it is, products. And, you know, they basically, now I can't find the page. Oh, no, it's up here under markets. Look at all these different categories they have here. Foreign exchange is just one of them. There's so many here. I can buy options or futures or on agricultural commodities, cryptocurrencies, energy, equity indexes like the Dow Jones Industrial Average, foreign exchange, interest rates, precious metals like gold and silver and platinum. And there's so many different types of derivatives we could buy. Over here, you can see we have oil, we have soybeans, we have corn, you name it, gold and copper. There's probably a derivative available written on it. And I can use that to hedge the risk if I'm dealing with those markets. So, but among the most popular ones are these foreign exchange derivatives where you have the ability to hedge foreign exchange risk. Okay, so anyway, so now we're going to take a quick look at the international financial markets. Now, we're very familiar with domestic financial markets. We know, for example, we can buy stocks through the New York Stock Exchange or many other exchanges. We can buy bonds through organized exchanges. But it turns out we can buy financial securities that are denominated in other currencies. I can buy, for example, as an American, I can buy British stocks. French citizens can buy American bonds through these markets. Now, the good thing about these is it gives me more flexibility, but the bad thing is that I'm suddenly exposed to foreign exchange risk. Okay, so if I buy a British stock, it's denominated in pounds and its value can fluctuate against the dollar. And I could end up losing money even if the stock itself does very well. So why would I do this? Well, I might just think that, British stocks are going to have a good year. Maybe it's worth the risk to buy them. Or maybe the French think that it's a time to buy American stocks. Or sometimes you're just keeping your money in a country that has higher interest rates. So this is a huge, huge market where you can buy and sell securities that are based on other currencies. They behave very similar to the domestic versions of these markets, but again, they all expose us to foreign exchange risk. So a few quick examples of the types that are out there. We have money markets, credit markets, we have bond markets, and we have stock markets. There's others too, but these are the main ones. So money markets are where you find basically short-term bonds are in this market. So these are securities that provide interest payments to the investor. The classic example of this would be treasury bills. Now, that the US government runs up enormous deficits every year. They spend way more than they take in taxes. And how do they cover their deficits? They have to borrow it. And one of the main ways they do that is to issue these securities, which are a type of bond. And what happens is, if you buy one of these securities, the government pays you interest, and then eventually you get your money back. So treasury bills are a case of government bonds where basically you're lending the government money, but for a very short period of time, meaning typically a year or less. Why are you doing this? Because you're going to get interest payments. You're not going to get a lot of interest, although it should be more than a bank, because they're very safe. Okay. Safe securities do not typically provide a very high rate of return. So this is where you might put your money, let's say if you're retired, or if you just want to put your money into something that earns interest while you're trying to figure out what else to do with it. Like corporations, for example, buy these things all the time because they might have money where they don't have anything to invest it in, and they want to earn some interest while they're thinking about what to do with it. So what I'm going to do here is go to a website real fast. It's actually the Treasury Department. And what they're going to show you is the interest rates that are being paid on Treasury securities at the moment. And let's take a look. So, oh, what happened here? I think I picked the wrong one. All right, well, let's look at these. These are Treasury bills. Now, what are they showing us here? These are the securities you can buy from the government. And you see that the maturities can be 4 weeks, 8 weeks, 13 weeks, 17 weeks, 26 weeks, and 52 weeks. They don't go any further than a year. And your interest rates are shown here. So this is the one we should be looking at, coupon equivalent. And that means if I buy this one, the interest rate that I'm entitled to is 4.33%. Okay. So if you look across here, they're all very similar to each other. So this is what I can earn at the moment using or buying one of these treasury bills. So for a year, I can earn approximately 4.17% by having this instead of putting my money in the bank. And even though it's a 1-year security, if I need the money in a hurry, it's easy to sell it to another investor. These markets are very, very liquid and very safe. So there's no risk in buying it. And because it's the government that issued this, I know they're going to pay me. Okay. With a corporation, well, corporations can go out of business. The government can't go out of business. And so they're going to pay me regardless of what happens in the market. So I can feel comfortable putting my retirement money in here, for example. Okay, so these are very, very popular securities. They're held by banks and corporations and pension funds. And not only that, but a lot of foreign companies and countries, central banks do own treasury securities because they're so safe, right? So in other words, it's a huge market. Everybody in the world potentially could buy US Treasury bills, but for foreigners, buying these means they're exposed to foreign exchange risk, okay, because they are denominated in dollars. So, like for example, the Central Bank of China owns over $1 trillion of these securities. They obviously believe that they're very safe. Okay, they're not apparently worried about the foreign exchange risk, but this is their idea of a good investment. By the way, there's others too. If you're determined to buy securities from the government, they have other maturities as well. So this is the full list. So these are the treasury bills, but you can also buy others that have longer maturities like 2, 3, 5, 7, 10, 20, and 30 years. And these are the interest rates that they're currently paying. Okay. So these, but the short-term ones, the treasury bills, are going to trade in the so-called money market, along with other securities that are very safe, very liquid, but also pay relatively low rates of interest because of their safety. Now, I can go into this international money market and buy treasury securities, but I can also buy securities issued by, let's say, the UK government. The comparable bills issued by the UK government would also trade in this market. So if I'm interested in earning the British rate of interest, I can do so by buying British treasury bills or the equivalent. So what's different here than the domestic money market is the availability of foreign securities, which of course, again, expose me to foreign exchange risk, but I might be interested in these securities even with that risk. So it gives me more flexibility. Now, it used to be kind of awkward to make these arrangements, but now if you have an account with any commercial bank, you should be able to invest in international money markets without too much difficulty from your account. It's easy. They make it easier for you. Now, not so much savings banks, but commercial banks, a lot of them are foreign exchange dealers, so they will have no trouble getting their hands on these securities if you want them. So we have treasury bills. Now, commercial paper is issued by corporations. It's a type of bond basically that provides interest to investors, but it also expires or matures very quickly within like 9 months, I believe. And then bank reserves, these are funds that the banks have available to lend out to customers, or else they can trade them in this money market. Okay, and because they do earn interest. Right. So these are just some examples of what you might find in the domestic money market. In the international market, what's changed is that the securities may be issued in foreign countries by foreign governments, foreign corporations, and it would therefore be denominated in foreign currencies. Now, the biggest customers of these would be multinationals. Let's say you're a big company that does business in England. Well, you've got funds tied up in England. You may find it necessary to invest them in British Treasury securities because they're denominated in pounds. They're going to give you a rate of interest in pounds. And when they mature, you'll get more pounds that you can use to pay your bills in Great Britain. So you can see the convenience of this. Now, credit markets, they're comparable to money markets, except that the maturities are longer. So this is where you might find, like, for example, 2-year, 5-year, 10-year treasuries instead of the treasury bills that are at the short end of this yield curve. Okay. They could be issued by governments, by corporations. But the key here is that the time frame is longer than in the money markets. The money markets are usually defined to have securities that last 1 year or less. Here we're looking at a range of typically between, let's say, 2 and 5 years, maybe up to 10. So with these securities, if you buy one, you may be able to sell it, before it matures, but you're basically investing for a fairly, let's say, an intermediate length of time, 2 to 5 years or so. The bond markets are where we saw the really long-term bonds, like the ones I showed you in this chart, 10, 20, 30 years. That's pretty far out. And so this is for long-term investors who, they want to hold on to these securities for many, many, many years and continue to earn interest well into the future. So for the international bond markets, you can buy bonds issued in any country. Typically, these are issued by governments or possibly very safe corporations. Okay. And the interest that you earn will reflect the amount of risk involved, if any. And then finally, we have the international stock markets. Now, of course, every country has stocks for sale from their corporations. They usually have several different exchanges where they trade. And so you may be tempted to buy stocks issued by foreign companies in those countries. So now the Wall Street Journal does have a list here somewhere. I saw it earlier of foreign stock indexes. Oh God, I'll never find it now. Let's just quickly see if I can find that. Wall Street Journal, foreign stock indices. Well, these are quotes for, let's say over here, this would be the international bond market. The US 10-year Treasury bond is note it's called. These are the equivalents in these foreign countries. In other words, these are bonds issued by these governments that last 10 years. The German equivalent pays 2.564%. UK is 4.621. I can buy any of these in the international bond markets. Okay, but I have to be prepared to bear the foreign exchange risk. What else do we have here? Well, these are the currencies. We saw these earlier. Oh, here we go. Like the Nikkei 225, that's the Japanese equivalent of the Dow Jones. UK, the FTSE 100 is their equivalent of the Dow Jones. So that means there are, in the Japanese Nikkei case, there's 225 stocks in this index. For the UK, it's 100 stocks. And I can buy any or all of those in the international stock market. In fact, what we could do, if you want, we can look up some stocks that are listed on those exchanges. For example, let's say what stocks are listed on the FTSE, they call it 100. It's actually, it's an acronym for Financial Times Stock Exchange. Okay. All right, what's on here? Let's see. Well, here we go. You've probably heard of some of these companies. Not so far, I'm not seeing any that look familiar. Coke, well, all right. It's interesting how Coca-Cola is listed. That would be the British branch of Coca-Cola, I guess. Look at that, British American Tobacco. No, this is wild. I'm not recognizing a lot of these companies. But if I want to buy Unilever, well, this is an American company, but they must have a British division that issues stocks in pounds because they need the money in pounds. Wow, this is interesting. But you can see I can buy any of these in the international stock market. Now, if you notice though, let's say I go to finance.yahoo.com and I say to myself, I'd like to buy a share of Toyota, but I don't want to buy or I don't want to bear the foreign exchange risk of buying a Japanese stock that's denominated in yen. What other option is there? Well, most major foreign corporations issue some of their stocks in the United States. So Toyota here is listed as being on the NASDAQ. What's going on here? Well, when a foreign company issues stocks in the United States, they take a special form called an ADR, American Depository Receipt. And basically, what you have here is Toyota stock where the currency is the dollar. Okay. In other words, in order to attract American investors, they can issue shares of stock in the United States, but they have to be denominated in dollars. And then they're known as American depository receipts. So that way, I, as an American, can buy a foreign stock without bearing the foreign exchange risk. Okay. Or I can go to Tokyo and buy the same stock listed in yen. So that's my decision. If I'm willing to take on the foreign exchange risk, I can get it on the Tokyo Stock Exchange. But if not, I can buy it right here in the United States on the NASDAQ as if it were an American company, but it's actually known as an ADR, American Depository Receipt. Okay. And so you notice it says it right here, US dollars. That gives us another option as American investors. I think you'll agree, most of us don't want to deal with foreign exchange risk. So if we really are interested in Toyota, we'll find it as an ADR. Okay. Then that's here, it's listed here. All right. So now that is my part of this chapter. There's also, like I said, the book's got its own chapter 3 that I want. They kind of overlap to a certain degree, but I wanted to make sure that I was able to expand on and clarify a lot of these concepts. So if you look at, here it is. This is what comes with the book. And you'll see, it covers some of the same ground, but not all of it. So now, last time when we were in person, we kind of just ran through and finished all the material and went home early. Normally, when we do this online, especially because it's actually quite late at night, it usually makes sense, I think, to have a break in the middle somewhere. So I'll tell you what, why don't we knock it off for about, let's say, 20 minutes or so you can get something to drink or eat. And then we'll meet up again, let's say 9:15. How does that sound? All right. So I'm going to leave this thing on because I don't want to risk turning it off and not having it come back on again. So I'm going to leave it going. What I can do in order to make the recording not contain 25 minutes of blank space, I'm going to pause the sharing so that this part of the recording will be temporarily interrupted. So that cuts out a lot of dead air on the recording. Okay, so let's do that. And let's get back here at about 9:15. That should give you plenty of time to have anything you want to eat or drink. And then we'll knock it off. We'll finish up at our usual 9:45. We'll go into this chapter here and see what they have, which examples they have that were not in my slides. Okay. All right, let's do that. Okay, so we're back for a while. So let's take a look at the notes, the official notes from the book. And so what they're going to do is some of the same material, but um, they're introducing of course, the different financial markets that we'll see throughout the course. But here, we're looking at the foreign exchange market and the different types of financial markets that where we can buy and sell stocks and bonds and other types of securities that are denominated in many different currencies. Now, by the way, here's something that they added that I didn't have in mind. At some point, maybe later on, we're going to spend some time looking at the history of the monetary system, where we can see that there's been many different kinds of exchange rate systems that have been tried throughout history. And so what we have now is called a floating exchange rate system because currency values are determined in foreign exchange markets. In other words, 100% by supply and demand. I'm assuming everyone here has had some basic economics courses, but we'll see later on that the book is going to spend a fair amount of time trying to analyze exchange rates with supply and demand graphs. So we'll review those when we get to that point. But with the floating exchange rate system, we'll see that the dollar, for example, the strength of the dollar is determined by how much people want to buy the dollar and how much Americans are willing to sell of the dollar. So just like any other asset in the marketplace. But previously to that, we had other types of systems. So I briefly mentioned before the idea of the fixed exchange rate with the Hong Kong dollar. That's an exceptional case in this day and age, but you can see that way, way back, right after the World War II, where after World War II ended, we had the so-called Bretton Woods Agreement in place. And what that was a system of fixed exchange rates between the United States and Western Europe and many other countries like Japan. And so the idea here was that having a system of fixed exchange rates would do one very important thing, and that was eliminate foreign exchange risk between these countries. And so the idea here is that, or the hope was that having fixed exchange rates, meaning no foreign exchange risk, would make it easier to reestablish trade relations between the United States and its allies. Okay, now remember, Western Europe was in pretty rough shape after World War II. It needed to be rebuilt and in a hurry. And so the Marshall Plan helped along with that. But the thinking was that the quickest way to reestablish Europe, or sorry, rebuild Europe, would be to reestablish trade relations between the countries. And so this was meant to be a way of helping that happen. And the system worked pretty well for almost 30 years there, but eventually it was abandoned, but it really became not so much. It did its job, and then it wasn't really needed any longer. And so since that time, since 73, we've pretty much had almost exclusively floating exchange rates in most countries throughout the world. Okay. Now, if you see there at the very top, before World War I, we had a fairly long period of time with the gold standard. And with the gold standard, that means that gold is treated as a form of money, meaning that you can spend it directly, and that you can at any time take your dollars to a bank and exchange them for gold. So it was a very interesting period in history. And it had a lot of advantages, among them being very low inflation and basically very little foreign exchange risk because currencies were defined in terms of their gold content. So it was a very stable and prosperous period. But unfortunately, World War I came along and that kind of took care of that. Okay. So that's one of the reasons why, not the only reason, but one of the reasons why we no longer have a gold standard because it was interrupted by World War I. And when the war was over, it proved to be very difficult to reestablish it. And eventually it was decided that it no longer made sense to have a gold standard. So we'll look at these in more detail later on, but this is a bit of brief history so that we know how we got to the point today where we have almost exclusively floating exchange rates. Now, here they're discussing the foreign exchange market. With foreign exchange markets, we know that this is actually an over-the-counter market. There is no exchange in which we can buy or sell foreign exchange. And dealers are the ones where we buy and sell currencies. Now, the market where we buy and sell currencies for immediate delivery is referred to as the spot market. Okay. Remember we talked about forward contracts before. That's referred to as the forward market, where currencies are paid for or bought for delivery in the future. If I buy a currency with the intention of taking delivery today, we call that the spot market. And the exchange rates in that market are called spot exchange rates. Okay. So if we look up in the Wall Street Journal and we see that, for example, let's go back, or the Bloomberg's, whatever, that the current exchange rate between the dollar and the pound, oh wait, that's not what I wanted, is $1.2242 per pound. We call that the spot exchange rate, which means that this is for transactions that will take place immediately. If I want to buy the pound in 3 months, the price that I'm quoted is called the 3-month forward exchange rate. Okay, so that's the forward market. This is the spot market. And sometimes it's called the interbank market because for the most part, the dealers themselves are either commercial banks or maybe investment banks. Okay. All right. Hold on a second. I have to take care of something real fast. Hold on a second. All right. Now, now, by the way, you probably experienced this. Even though every country has its own currency, the dollar is in a special position. Remember, we saw before that it is the world's vehicle currency. There's a lot of countries in the world where you don't have to bother converting your dollars into the local currency. You can spend them directly. So, for example, in South America and Latin America, in the Caribbean, a lot of these countries depend very heavily on trade with the United States. So if you, let's say, are going to the Bahamas or Bermuda or Jamaica, these are the kinds of countries where their incomes come primarily from tourism. And so when American tourists show up in these countries, they don't have to bother trading their dollars for the local currency because the locals actually would prefer to have dollars. Okay, why is that? Because dollars are strong, they're stable, their value is predictable. So in fact, in some of these countries, you'd be hard pressed to find anybody who's actually using the local currency. I mean, of course, banks do, but most of the businesses are actually using dollars. Okay, so that's because of their stability, their the strength of the dollar, their predictability. So the dollar is pretty important in those countries. Now, for banks that do deal in foreign exchange, what are some of the good things about this? The quotes are very competitive. In other words, you can buy at the lowest possible price or sell at the highest possible price. You can execute your trades very quickly. And if you need to, you can get advice about current market conditions, forecasting advice. So in other words, if you have an account with a large commercial bank like Chase or Citibank, let's say, you would find it very easy to get your hands on foreign exchange at a very low price. In fact, I'll give you a helpful hint here. If you're in a foreign country and you need a foreign currency, usually the cheapest way to get that currency is not to go to a dealer, but to use your credit card, actually. Okay. So if your credit card is issued by a major foreign exchange dealer, then they will give you the best possible price because they're not making their money on the exchange rate itself, but they're making it on the interest that they're charging you. And we already have discussed very extensively bid-ask prices, so we understand how that works. Um, Here's something we haven't really discussed. What is it exactly that determines the size of this bid-ask spread? Well, there's several things, but obviously you can see competition, the trading volume, the size of the transactions, the risk of the currency itself. So for very stable currencies like the pound, the bid-ask spread would tend to be lower than for a riskier currency like, let's say, the Turkish lira. Okay, so because the dealers don't want to be holding a currency that loses value. So for them to hold an inventory of a currency, they're bearing a risk of some kind. And so that will be reflected in the bid-ask spread. Volume, like we said, very heavily traded currencies will tend to have lower bid-ask spreads. And then the risk of a currency, the higher the risk, the higher will be the bid-ask spread. Oh, and by the way, so remember we saw this before, the quotes. Let's go back to the Wall Street Journal for a second. Remember, they were the ones who listed currencies in two different ways. There we go. All right. So if you notice, for example, again with the dollar and the pound, let's go find that one. So it takes $1.2245 to buy a pound or 0.8035 pounds to buy a dollar. Now, the one that requires or where the quote is, let's say dollars per pound, in the United States, this is called the direct quote. Okay, here it is. This would be called the indirect quote, right? And it makes sense when you think about it because every good or service you buy in the United States is quoted in terms of dollars. How many dollars per gallon of gas, for example? So if the exchange rate is also dollars per unit of the foreign currency, we call that the direct quote, and the opposite would be called the indirect quote. So all currencies can be quoted either way, but there's some conventions that we tend to see followed in these markets. For example, you almost always see the exchange rate between the dollar and the pound quoted as so many dollars per pound. With Japan, we almost always see the quote as so many yen per dollar. Okay. You can kind of see why. Look at the yen, 155.53 yen per dollar. If we flip that around to dollars per yen, it's a tiny little number, 0.00643. And I think you'll agree that's kind of awkward to deal with. Right. So then they're going to talk about, oh, now this is something we didn't talk about, appreciation and depreciation. So this is awfully, awfully important. So I'm going to come back here and sneak this into my slides. Let's see, hold on one second. Although we'll talk about this more later on in the course, but I think it's worth mentioning this right now. We have quotes for currencies, but they do change over time. Okay. So, for example, let's say we have these quotes available to us, and let's say tomorrow these change, right? So let's sneak this in here. Currencies change value frequently. And so, for example, suppose that the exchange rate between the dollar and the pound all right, we'll use the same number. Now, here's the big question. Suppose that tomorrow this rises to, oh, let's say 124 per pound. Now, when something like this happens, let's say make it 401 or something like that. So what happens is one of these currencies has gained in value and the other has lost in value. So the question is, which is which? So here's how to think about it. So since the exchange rate rose from 122.96, in other words, the pound got more expensive is what's just happened here. I have to use more dollars to buy the same British pound. That's the key detail. The pound has become more expensive. This means that the dollar is now weaker and the pound than before, I mean, and the pound is now stronger. So we say that the dollar is said to have depreciated. That's the correct terminology here. And at the same time, though, the pound is said to have appreciated. Okay. Now later on, we'll see how this affects the economies of the two countries. But as long as the price went up like this, because it takes more dollars to buy a pound, that means that the dollar has gotten weaker. We say that it has depreciated. The pound has gotten stronger, and we say that it has appreciated in value. Now, this happens every single day. I mean, currencies rise, they fall, but sometimes they start to rise or fall for extended periods of time. And you can see there are cases where currency keeps dropping, and they can fall very quickly in a hurry if the markets become very pessimistic about a currency. So you do see this every so often. Like when the British left Brexit, I'm sorry, when they left the European Union during the Brexit, the pound fell off very dramatically, and it really hasn't recovered since then. Okay. So, a lot of this is based on market sentiment. And so currencies can lose a lot of value in a big hurry, but they can also rally very quickly. So they're very volatile assets, to say the least. And a lot of, like I said, is driven by market sentiments. And here they're giving us some quotes, places to find foreign exchange if we need it, like I showed you before, the Wall Street Journal or Bloomberg. Here they're explaining to us the concept of cross exchange rates, which we have already talked about. Derivative contracts, yes, we have a pretty good feel for that now, although again, we'll see much more about this later on. Let's see. Let's jump ahead a little bit. The international money market is where investors buy or sell securities that have very short maturities and pay interest to the investors. These securities are very safe, they're very liquid, but they provide relatively low rates of interest. Now, sometimes what we can do with these markets is, if you're a multinational and you do business in a lot of countries, you may be able to put this to your advantage by being able to borrow in the countries with the lowest interest rates and invest in the countries with the highest interest rates. Okay, so you may be able to do this if you are a multinational that has branches in many different countries where you have the right to invest in different money market securities. If you do this correctly, if you manage this wisely, you may be able to save some money when you borrow, or earn a higher rate of return when you lend. Okay, so that's one of the reasons why this market is so large. But of course, you also may simply need to have the right currency in order to buy imports. If you're, again, an importer, you may need to buy, let's say, British pounds, and it might be easiest to get your hands on them in the international money market. Now, obviously, now they're telling us here that basically a lot of this takes place in Europe. But we also have an Asian money market as well, in Hong Kong and Singapore. By the way, we have this interesting market here called the Euro currency market. And what happens there is that you can hold bank deposits in countries outside of the country of origin. In other words, let me slip this into here somewhere, because this is quite interesting and important. It's kind of, I'd say it's part of the international financial markets. I'll sneak this in at the end here. We have what are called the Euro currency markets. And what's happening here is that these are bank deposits held outside is a bank deposit held outside the country of origin. In other words, for example, if a multinational corporation holds dollars in a British bank account, these are known as euro dollars. And by the way, they earn the dollar rate of interest, not the British pound rate, but the dollar rate of interest. So you can see it's awfully convenient to be able to hold different currencies in different banks throughout the world. Again, if you're a multinational, let's say you're doing business in England, you'll get maybe some of your revenues are in pounds, maybe some of them are in dollars, maybe you've got expenses denominated in dollars, or you have investments. So it's very easy, it's very convenient that you can have both dollar deposits and euro pound deposits in your British bank account. Now, this market is a relative newcomer. The euro currency markets really got going in the 50s. But once I got started, it became clear that there's a huge demand for these types of deposits. And so London is the center of the euro currency markets, not New York City, but London. Okay. This is where the majority of these deposits are held. And so it's very convenient for multinationals to have access to these markets. Now, I'm thinking, you and I could probably do the same thing, but there might be large minimum requirements. There's probably easier ways for us to acquire foreign currencies than with euro currency deposits. Now, by the way, here's an interesting chart showing you the euro money market interest rates. Look at Brazil. It's so much higher than the others. Usually, this is a sign that this country has a relatively high inflation rate. If you notice Japan, it's close to zero because their inflation rather has been close to zero for over 30 years now. They just don't have any inflation over there. It just doesn't happen. So their interest rates are very close to zero, and they have been for many, many years now, decades, really. The United States has relatively low interest rates. And you can see as we work through the list, there's a pretty strong connection between these interest rates in the money markets and the inflation rates in those countries. Let's see. Looking for something. Oh, here we go. Okay, closely related to the euro currency markets, we have the euro bond markets, which are let's see, let me go find the formal definition. These are bonds issued outside the country of origin. For example, let's say you are Volvo, which is a Swedish company, and you build your cars some of your cars in the United States for the American market, but you need to borrow money, but not dollars. You want to borrow kroner. That's the Swedish currency, by the way. You can issue bonds in the United States that are denominated either in dollars or in kroner. And if you denominate them in kroner and sell them to American investors in the United States, they suddenly become euro bonds because they're because kroners are being borrowed outside of the United States. Okay, so in other words, just like with the other international securities that we've been looking at, it's possible to borrow in a currency other than that of the domestic country. So if you want to issue bonds in the United States, mostly they're dollar denominated, but sometimes they're denominated in a foreign currency, and then we know them as euro bonds. Okay. Now, on the other hand, what if Volvo does, here we go, decide to borrow in dollars? Then it's known as a foreign bond because it's a foreign company. And then what's funny is they all have these very interesting names. For example, you notice here Bulldog bonds are dollar bonds issued in the US by British companies. Matilda, I believe, is Australia, and Samurai is Japan. So let's add that to our list here. Just to make sure just for completeness sake, Euro bonds issued in a currency other than the domestic currency. For example, if Volvo issues bonds in the United States that are denominated in kroner, which is, by the way, that's the plural of krona, which is the Swedish word for crown. Okay, they are euro bonds. Foreign bonds are issued in the domestic currency, but by foreign entities. So if Volvo issues bonds denominated in dollars in the United States, they are foreign bonds. Okay. So again, these are an important part of the international financial markets. Um, you probably wonder, why is Volvo borrowing their money here, not in Sweden? It might just be that interest rates are cheaper or lower in the United States, or it may be simply more convenient, to finance the operations of their U.S. operations. So it's not that unusual for foreign companies and foreign governments to borrow in the United States. It happens quite often, as a matter of fact. The question is whether their bonds are issued in dollars, which means they're foreign bonds, or in their own currencies, which makes them euro bonds. Okay. All right. So let's see. Other than that, oh, by the way, this is a little bit of a history lesson. The Greeks have run into trouble a couple of times by having such massive deficits that people were worried they would never be able to pay them. And so this is what led to rumors that they might have to give up the euro. But and this happened a couple of times in 2010 and 2015, but it hasn't happened yet. They did not have to drop out. So the euro is still in force, but there were a couple of times when it seemed like they were getting close to the brink and that they might just have to drop out. So, all right. Anyway, I think that's enough of that. So we're done with chapter 3 now. And I think that will suffice for tonight. So next week we'll dive into chapter 4. All right, let's see, what is chapter 4? I don't even remember. Hold on. Oh, all right. We'll look at it next time. Yeah. So it's getting very late. So I'll tell you. Next week we'll do 4, and then we'll take it from there. So we'll meet at the same time in the same place. Now, in the meantime, by the way, these recordings will be made available on YouTube, but because of the interruptions, it's possible that it's broken up into 2 or 3 pieces, but it'll be there. As soon as they're ready, I'll put them up there, and that way you can watch them if you missed anything. Okay. So there's going to be another assignment. There should be an assignment every week. I think these assignments are going to be like basically a week behind where we are. So I'm pretty sure that this week you'll have to do chapter 2. No, I forgot. No, we're 2 weeks. Well, we're behind. No, that's okay. It's better than trying to have you do assignments that we haven't done yet. So this coming weekend, Sunday, you're supposed to do the chapter 1 assignment. Oh, no, we're all set. We don't have anything to worry about there. You're definitely, we just finished chapter 3, so we're in good shape. Okay. Beautiful. So, all right, so let's stop there. So just don't forget about this assignment. It's due Sunday night, but if you have, let's say you can't quite finish it, remember it'll give you 2 extra days according to the late policy. And the only thing is, if you're late, it'll take off 10% as a late penalty, which isn't that much. So in other words, don't give up. Keep working on it. You have 2 more days to finish it. All right. And I see so far the people who have done it have done quite well, and that's good. All right. All right. So I guess I'll see you all next Tuesday then. And by the way, I'm still not certain that the same link I sent you tonight will work next week. I don't know enough about it, but I think my intention is to send you a new link every week just because I'm not sure if that's going to help. I mean, use the same link. So I'll send a new one out every week, and then we'll use that to do this class. Okay. All right, so I know it's getting late, so good night, everyone, and I'll see you next week.
Good night.
Okay, all right, bye.